On the morning of June 12, 2026, a company that had spent more than 2 decades deliberately avoiding public markets finally gave in. Shares opened at $135 apiece on the Nasdaq. By the time the closing bell rang that afternoon, a single offering had raised roughly $75 billion, shattered the record for the largest initial public offering in history by a margin so wide it wasn't really close, and instantly created a company valued at $7 trillion on its very first day of trading. 3 days later, that number wasn't even close to finished climbing. This is SpaceX, not just a rocket company anymore, not just the business that quietly took over launching most of the world's satellites, while nobody outside the aerospace industry was paying close attention. By the time its shares hit the public market, SpaceX had already folded in an entire artificial intelligence company, a global satellite internet network bigger than any competitors, and one of the most used social media platforms on Earth, all stitched together into a single entity that the prospectus itself, in writing, described as targeting a total addressable market worth $5 trillion. That's not a typo. That's larger than the entire annual economic output of every country on the planet except the United States and China. By the end of this video, you're going to understand exactly how a private rocket company spent 2 decades building toward a single morning that reshaped global markets, why the most consequential part of this deal might not even be the rocket business at all, and why the man who built it walked away from a single trading day roughly $1 trillion richer than he started it. If you want to understand the mechanics behind the biggest single wealth creation event in financial history, in real time, stick around, because this one moves fast. And if deep dives into how money and power actually move through markets like this are why you're here, the subscribe button is right there waiting. Let's go back to where this story actually starts, because the IPO itself was the final step in a plan that had been building for years, not a sudden decision made on a whim. SpaceX was founded by Elon Musk in 2002 with a stated mission that sounded, at the time, almost absurd: build reusable rockets, dramatically lower the cost of reaching orbit, and eventually establish a permanent human presence on Mars. For most of the company's existence, that mission required exactly the kind of patient, long-horizon investment that public markets are notoriously bad at tolerating. Quarterly earnings calls do not mix well with 10-year engineering bets on rockets that occasionally explode on the launch pad as part of the development process. Musk understood that tension better than almost any other founder in modern business history. And for 2 decades, he kept SpaceX deliberately, stubbornly private, specifically to protect it from the short-term pressure a public listing brings. What changed by 2026 was that the company had quietly built 3 separate massive businesses inside the same private corporate shell. And at some point, the math of staying private stopped making sense. The first business is the one most people already know: Falcon 9, the reusable rocket with the best reliability record of any launch vehicle in history, alongside Falcon Heavy, and the long-awaited Starship program, the most powerful rocket ever built, finally proven out after years of very public testing failures. SpaceX became NASA's primary launch partner after the Space Shuttle program ended in 2011, and over the following decade and a half, it didn't just compete with the rest of the global launch industry, it largely replaced it. NASA contracts, Department of Defense contracts, Space Force contracts focused on next-generation missile defense and resilient satellite communications, dozens of nations' commercial satellite launches. An enormous share of all of it has flowed through a single private company's launch pads for years. The second business, and the one that actually pays SpaceX's bills today, is Starlink. What started as an ambitious satellite internet project, beaming broadband down from a constellation that now numbers somewhere around 10,000 satellites in low Earth orbit, has become the company's single largest revenue driver by a wide margin. In the most recent quarter before the IPO, SpaceX reported total revenue of roughly $69 billion, and the overwhelming majority of it came from Starlink subscriptions, not rockets. The prospectus broke the company into 3 formal segments for investors to evaluate: space, connectivity, and AI. Connectivity, meaning Starlink, is the one quietly generating the cash that funds everything more glamorous happening at the other 2. And then there's the third business, the one that didn't exist inside SpaceX at all until just a few months before the IPO, and the one that fundamentally changed what kind of company was actually about to go public. In February of 2026, SpaceX formally acquired xAI, Elon Musk's artificial intelligence company, in an all-stock transaction that folded xAI in as a wholly owned subsidiary. The combined private valuation at the time of that merger was reported at roughly $25 trillion, with SpaceX itself valued around $1 trillion and xAI valued around $250 billion. CNBC described it, when it was announced, as the largest private merger ever completed up to that point. Musk framed the deal in characteristically sweeping language, calling it an attempt to build, in his words, the most ambitious, vertically integrated innovation engine on and off Earth. combining artificial intelligence, rockets, space-based internet, direct-to-device communication, and what he called the world's foremost real-time information platform, a reference to X, the social media company formerly known as Twitter, which had already been merged into XAI before the second merger folded the whole stack into SpaceX. There's a more grounded explanation sitting underneath that sweeping language, and it has everything to do with money. XAI, the company behind the Grok chatbot, was reportedly burning through roughly $1 billion a month trying to keep pace with much better funded rivals like OpenAI and Anthropic in the increasingly expensive race to train and run frontier artificial intelligence models. Folding XAI into SpaceX gave the AI business access to a vastly larger balance sheet, one funded by Starlink's actual profitable revenue, rather than forcing XAI to keep raising standalone funding rounds on its own thinner financial footing. The second motivation was more speculative and more ambitious. Musk has argued publicly repeatedly that Earth-based power generation and cooling infrastructure simply cannot keep up with the explosive energy demands of training increasingly large AI models, and that orbital data centers, satellites built specifically to host AI compute in space, could eventually solve that bottleneck. SpaceX's existing launch capability and its enormous satellite network make that vision at least theoretically achievable in a way no other company on Earth could currently attempt, even if the idea remains, for now, almost entirely unproven. It's worth being honest about the messier parts of that AI integration too, because the prospectus itself didn't hide them, and a balanced look at this deal has to include them. By April of 2026, Musk himself had publicly acknowledged that XAI's underlying technology, the system powering Grok, had not been, in his words, built right the first time around, and needed to be rebuilt from the foundations up. Grok had also drawn serious legal and regulatory scrutiny in both the United States and Europe after the platform was found to have enabled the creation and spread of non-consensual, explicit deepfake content. Those are not minor footnotes. They represent real legal exposure and real reputational risk that public market investors are now underwriting alongside the rocket business, whether they fully appreciated that when they bought shares on day one or not. So that's the company that actually walked into the public markets on June 12th. A rocket and satellite business with an extraordinary engineering track record, fused together with an AI division carrying real unresolved controversy and serious cash burn, all wrapped inside a governance structure built, very deliberately, to make sure none of that complexity would ever cost Elon Musk control of the company he built. That governance structure is, in many ways, the most important part of this entire story, because it tells you exactly what kind of public company SpaceX actually became, and it's considerably more unusual than most IPOs this size. SpaceX listed its Class A shares on the NASDAQ for ordinary investors to buy, but Musk retained a separate class of Class B supervoting shares, a structure modeled closely on the dual-class system he'd already used for years at Tesla. The practical effect is straightforward. Even though thousands of new institutional and retail investors now legally own a piece of SpaceX, voting control over major decisions still rests overwhelmingly with one person. Investors buying in on day one weren't really buying a stake in a conventional shareholder democracy. They were buying access to a controlled company, one where Musk's vision sets the direction regardless of what the broader shareholder base might prefer in any given quarter. And the compensation package built around that control is, on its own, one of the most extraordinary executive pay structures ever attached to a newly public company. In January of 2026, ahead of the listing, SpaceX's board approved a grant of 1 billion performance-based restricted shares for Musk. According to the prospectus itself, those shares only vest if two separate conditions are met simultaneously, across 15 equal tranches, specific market capitalization milestones for the company, paired with what the filing literally calls a human colony milestone, requiring SpaceX to establish a permanent human colony on Mars with at least 1 million inhabitants. Every single tranche requires both the financial target and the Mars target to be certified by the board, and Musk has to remain employed by the company the entire time for any of it to vest at all. Whatever you think of the ambition behind that structure, it's worth sitting with for a second. A publicly traded company, regulated by the Securities and Exchange Commission, has formally tied part of its CEO's stock compensation to the literal colonization of another planet. Nothing remotely like that exists anywhere else in the history of American public markets. And SpaceX's listing didn't happen in isolation. It was, very deliberately, the opening act of what analysts have started calling the most consequential wave of technology IPOs since the early internet era. Within weeks of SpaceX's debut, OpenAI confidentially filed its own draft registration with the Securities and Exchange Commission, targeting a valuation reportedly in the $850 billion to $1 trillion range, with a public listing expected sometime in the back half of the year. Anthropic, the company behind the Claude AI models, was separately reported to be targeting an October listing of its own, at an estimated valuation approaching $900 billion to $965 billion. Taken together, analysts following all three companies put the combined potential market value of SpaceX, OpenAI, and Anthropic going public within roughly the same 6-month window at somewhere around 6 to 3, $7 trillion, a figure that on its own exceeds the entire gross domestic product of every country on Earth, except a small handful of the very largest economies. SpaceX going first was not an accident of scheduling. Multiple analysts following the AI infrastructure sector specifically noted that SpaceX's listing was always going to function as a kind of market-clearing reference point, the deal that tells every other AI-adjacent company exactly how aggressively public investors are currently willing to price hypergrowth, unproven future markets, and founder-controlled governance structures all at once. Once SpaceX priced at $7 trillion, and then kept climbing toward $7 trillion within days, every banker assembling the OpenAI and Anthropic roadshows suddenly had a fresh, extremely favorable data point to point to. That's the part of this story that rarely makes it into the headline. A single IPO doesn't just create wealth for the company going public, it resets the entire pricing conversation for every comparable company waiting in line behind it, for better or worse, depending on whether the first mover stock holds up once the initial excitement fades. SpaceX priced its shares at $135, raising approximately $75 billion in the offering itself, comfortably surpassing Saudi Aramco's previous record-setting 2019 listing, which had raised $6 billion. At that initial pricing, the company was valued at roughly $77 trillion on day one, instantly placing it among fewer than 20 publicly traded companies in history that have ever crossed the $1 trillion threshold at all, a list that includes Apple, Nvidia, Aramco, and Microsoft. It's worth sitting with how unusual it is for a company to debut at this scale on day one at all, because most trillion-dollar companies earn that valuation gradually, over years or decades of public trading, as the market slowly reprices them upward on the back of actual earnings growth. Tesla itself, the company whose dual-class governance SpaceX borrowed directly for this listing, took more than a decade as a public company before it finally crossed the trillion-dollar threshold in October of 2021. SpaceX skipped that entire multi-decade process by staying private until its underlying businesses were already enormous, then stepping onto the public stage already valued at a level most companies spend a generation building toward. That's the structural advantage of waiting. By the time SpaceX finally needed public capital, it didn't need the market's permission to grow into a trillion-dollar valuation. It simply arrived, already there, fully formed on day one. But SpaceX didn't stop at the opening valuation. Within 3 days, the stock had climbed to around $178 a share, pushing the company's market capitalization to approximately $46 trillion. Within roughly a week of trading, some reporting placed the figure even higher, above $7 trillion. To put that in perspective, at its peak, SpaceX was worth more than the next 20 largest publicly traded pure-play space companies on Earth combined, by a margin of more than $2 trillion. The center of gravity for an entire global industry shifted into a single company's stock price within days. And because Musk personally holds roughly 42% of SpaceX's equity, that explosive repricing did something to his personal net worth that had never happened to any individual human being in financial history before. It pushed him past $1 trillion, making him the first person on the planet to officially hold trillionaire status, at least on paper, based on the market value of shares he already controlled before a single new share was sold. It's worth pausing on exactly how aggressive a bet the market was actually placing here, because the valuation only makes sense if you take SpaceX's own stated ambitions completely at face value. At $46 trillion, the company was trading at roughly 130 times its entire 2025 revenue of $7 billion, a year in which SpaceX posted a net loss of $9 billion on its overall operations, even as the Starlink connectivity segment alone generated a healthy $4 billion operating profit. That gap between revenue, profitability, and valuation is the entire story of this IPO in miniature. Investors weren't pricing SpaceX based on what it currently earns. They were pricing it based on the markets it says it's about to enter. The prospectus laid those markets out in striking detail. An $870 billion addressable market for Starlink's broadband business alone, a $740 billion market for its mobile connectivity unit, a $600 billion digital advertising market through X, a $4 trillion market for AI infrastructure, and beyond all of that, a staggering $7 trillion enterprise applications market. The company believes it can eventually compete in through an AI agent platform it's developing, reportedly with help from Tesla, called Macrohard. designed to emulate digital knowledge work at scale. Whether SpaceX actually captures a meaningful share of markets that large is, as of right now, completely unproven. What's not in question is that the market chose, almost immediately, to price the company as though it already had. This is exactly where the deeper, more uncomfortable question about this entire IPO actually lives, and it's worth sitting with honestly, rather than just marveling at the size of the numbers. A $7 trillion valuation built on 130 times trailing revenue and a current net loss is not a valuation grounded primarily in present-day fundamentals. It's a valuation built almost entirely on belief that Starship will keep working reliably at scale, belief that Starlink can keep growing its subscriber base globally, belief that the rebuilt version of xAI's technology can actually compete with much better funded rivals, and belief that space-based AI compute, an idea that exists right now mostly as an argument in a memo rather than a working system, eventually becomes real. Markets have priced extraordinary belief into valuations before, and sometimes that belief has been spectacularly vindicated, the way it eventually was with Amazon. Sometimes it has not been, the way it wasn't with WeWork, a company whose IPO collapsed entirely once investors actually examined how deep its losses ran. SpaceX's engineering track record is, by any honest measure, considerably stronger than WeWork's ever was. But the valuation math underneath the headline number is genuinely speculative. Regardless of how impressive the rocket footage looks, the speed of what happened next only reinforced how much raw financial firepower this single transaction had just handed the company. Within days of the IPO closing, SpaceX used its newly minted, rapidly appreciating public stock as direct acquisition currency, announcing a $60 billion all-stock purchase of Cursor, a fast-growing AI coding startup, explicitly aimed at making Grok and SpaceX's broader AI ambitions more competitive in software development tools against rivals like OpenAI and Anthropic. Think about what that sequence actually represents. A company goes public on a Friday, and within roughly a week, it has already used the resulting stock surge to swallow a $60 billion acquisition target whole without needing to raise a single additional dollar in cash. That is the practical, real-world power of a successful trillion-dollar IPO. It doesn't just create paper wealth for existing shareholders. It hands the company an entirely new acquisition currency, one that lets it consolidate adjacent industries at a pace that would have been completely impossible as a private company still dependent on slower, more cautious venture funding rounds. So who actually benefits from a single morning that reshaped this much value this quickly? And who's left holding the risk if the underlying bets don't pan out the way the prospectus promises? For Musk personally, the answer is almost too large to fully process. A $1 trillion net worth milestone, achieved not through a sale of any shares at all, but purely through the market's collective decision to value the equity he already held at a dramatically higher price than it carried the week before. For SpaceX's earliest employees and investors, the people who joined or funded the company back when it was still an unproven startup, repeatedly blowing up rockets on test pads, the IPO represents one of the largest single wealth creation events for early backers in the history of Silicon Valley, full stop. For the broader space and AI industries, the IPO instantly became what analysts now call the anchor valuation, the reference point every other publicly traded space company, satellite operator, and AI infrastructure firm gets measured against going forward, whether their own businesses actually resemble SpaceX's or not. But for the ordinary retail investor who bought shares once trading opened, hoping to ride the wave everyone was talking about, the math is considerably less guaranteed. They bought into a controlled company where their votes carry limited practical weight against Musk's supervoting shares. They bought a stock trading at valuations built on markets that remain, by the company's own admission in its own prospectus, almost entirely unrealized. And they bought exposure to an AI division still actively working through both a technical rebuild and meaningful legal and regulatory risk, layered directly on top of an otherwise extraordinary rocket and satellite business that, on its own, might have justified a much more modest, more defensible valuation than the one the combined entity commanded on day one. None of that makes buying in irrational, exactly. Plenty of early Amazon and Tesla investors who bought during periods of similarly aggressive, fundamentals-defying valuation went on to see extraordinary returns over the following decade. That's the real story sitting underneath the headline number. Not just that one company quietly became worth more than entire national economies in a single trading week, but that the way it got there, through aggressive consolidation, controlled company governance, and a valuation built largely on markets that don't exist yet, has become something close to the new playbook for how the most ambitious private companies in the world plan to go public going forward. SpaceX didn't just complete the largest IPO in history. It demonstrated, in real time, exactly how much raw financial power gets created the moment public markets agree to believe a story that large. If you want to keep tracking exactly where that $22.7 trillion enterprise ambition, the Cursor acquisition, and the orbital data center bet actually go from here, this channel exists specifically to follow stories like this one all the way through, not just for the headline week. Go ahead and subscribe now because there's a lot more of this unfolding in real time. So here's the question I want to leave you with, because I think it cuts right to the center of what just happened. When a single IPO can create more new wealth in 3 days of trading than most countries generate from their entire economy in a year, built substantially on markets the company itself admits don't fully exist yet, is that the market correctly pricing in genuine future dominance the way it eventually did with Amazon decades ago? Or is it the clearest possible sign that public markets in 2026 have become almost completely disconnected from the ordinary, boring relationship between current revenue and current valuation? Tell me where you land in the comments, because I think the honest answer probably depends entirely on whether Starship, Starlink, and a rebuilt version of Grok actually deliver on everything this prospectus just promised. And if you want to find out exactly how that bet plays out in real time, as the numbers actually come in over the next several quarters, make sure you're subscribed, because this is one of the biggest financial stories of the entire decade, and it's still only just getting started.